Of these theories that we have that has implications for investing, and it has a lot of implications for pricing, or some of our pricing theories. But here's kind of like a this is a random walk, okay? And so the random walk, we can kind of see it, everything starts at zero. Kind of looks like our Galton board, doesn't it? Okay? It's like each one of these is like hitting a different ring, hitting a different peg and going left and right. Okay? So then we have all these random walk simulations. And what's going on? Well, it's hitting the pegs, it's going up, it's going down. And this is my, the lower plot is, if I took a slice of this data and I calculated the standard deviation, I calculated the mean and the standard deviation, I'd see the mean was here, and the standard deviation looks like this. And then I get to here, and the standard deviation is getting wider. It's getting wider and wider. So basically the standard deviation of the returns are growing. And then we actually have, for this, happy Halloween, everyone. I guess it's going to be a wet one. I don't know what I'm going to do. Last year my daughter was Dorothy and our dog was Toto. So I don't know what we're going to do this year. So this is basically, so sigma, if I designate this as the sigma of time, is equal to sigma, which is a constant, times the square root of time. Okay, so that standard deviation is widening with the square root of time as it goes out, which the square root of time looks like that if you look at a plot of it. You know, so if this through time. So, and this is from, and this is our model, and this is from random walk theory. Okay, so the whole idea is, okay, well, the random walk works because the only thing that matters is where you're at, not how you got there. It doesn't remember anything about how you got there. So there's no information from the past that gets propagated into the future. It's all independent. Okay. Okay. Why markets tend towards efficiency? So today, the first half we're going to talk about efficiency. The second half of the class we're going to talk about inefficiency. Many informed traders chase mispricing. Information is widely and quickly disseminated. Incentives of trading to exploit mistakes moves prices towards fair value. So as people are able to identify information and say, this is a mispricing, I can exploit that and make a risk-free profit because of that mispricing. So, this is one reason why the market's going to trend towards being efficient. Okay, information is quite widely and quickly disseminated. Law of one price, no free lunch. So identical cash flows have to have the same price. So if I have two sets of cash flows, I can't, and they're identical, the price has to be the same. Or arbitrage is going to exist, where I can, buy one cash flow and sell the other cash flow short. Okay. It underpins informational. Law of one price underpins informational efficiency. It is the same backbone as APT. arbitrage pricing theory. So in other words, if I have two things and they're identical, they have to have the same price. Okay. Three forms of expected of EMH. First one is weak. Past prices, volume are in prices, no pure technical edge. Semi-strong says all public info is in prices. You can test this with event studies. And strong means the public and private info is in prices. It's too strict empirically to apply. It's pretty much everybody's, most of the stuff that you're interested in is in the weak. I'm not really interested in you guys understanding the difference between weak, strong, semi-strong, EMH. Just in terms of like understanding the concept that markets are in this domain are considered to be efficient. So the weak form, what does it imply? Autocorrelation of non-overlapping returns is equal to 0. Okay, so who here knows what autocorrelation is? Okay, auto means self. Correlation, so it's correlated with yourself. So how can you be correlated with yourself? Well, you should always be correlated with yourself, right? Correlation should be 1. Well, a stock price, the way, or any kind of asset, the autocorrelation is a measure of, and it gets back to, you know, as I said, this. From a random walk, in a random walk, I don't really, it doesn't really matter. I don't care how I got here. It's where I'm at. So basically where I'm at, my level determines where I can go to the next step. So if how I got here depends on, where I'm going to go depends on how I got here, that would be called autocorrelation. So there'd be information in the process of how you got to this point that was going to affect what's going to be at the next point. And if that's the case, if there's information, you could trade on it. Okay, you should be able to identify it. So autocorrelation is basically the correlation of today's return with yesterday's return. So how likely is today's return going to be? What is there information in yesterday's return that's going to basically have a strong determinant on my return in the next period? Okay, I'll go over how to calculate this, and we'll do a spreadsheet. I've got a spreadsheet I posted on the site of, I think it's GM versus S&P 500, but I also calculate the self-correlation of GM in it. But what we're really looking for is like, is there information in the price, in the changes in the price? So it's like, is there information in the returns? Does the previous return have something that tells you about what the next return is going to be? Okay. Okay. So looking at the number of top half performers, all domestic equity funds, there's 1,000 of them, 71.8% that perform in the top half of the sample in the year ending. Percentage that are still in the top half at the next period. Okay, so we're seeing that if we look at the large cap equity, again we're seeing 25 out of 61. We're seeing 16 out of 70 on the small cap. you would expect that the ones that are you know, who are here should be highly correlated over here. So what's going on? It's like, okay, well, the market's efficient and they don't have a structural advantage. And so, you know, net of fees, you end up overpaying for skill. Okay, because if the market's efficient, if it's totally efficient, there's no reason to hire a fund manager, right? There's no value add. You're just going to pay a fee. So semi-strong evidence, and this is, you know, this is where you could ask a question in an exam or something like, what's evidence of a semi-strong event? Big thing is event studies. And event studies are, you know something happened because they made an announcement, right? Like if you're going to do a takeover, you have to officially announce you're going to do the takeover, right? And you have to give the terms and everything. So we can see here we've got the cumulative, we're looking at cumulative abnormal returns, and all of a sudden it's like, you know, that's, what is that? What do you think that is? That's not a specific company. That's information leaking out. Somebody's friend of a friend told them about, oh, by the way, they're going to buy XYZ company, you know, and so this is all, you know, probably illegal insider trading. And then all of a sudden, boom. Once the information comes out, the market moves. So you can see the information is there, and once it's received, there's a significant signal. So basically, once the information's available in the marketplace, the prices react to that information. Okay. How fast does the information move? Well, here's, you know, I don't know what this show is, but somebody looked at a show that has, you know, I guess maybe they ring a bell or something, or, you know, they say this stock is great or this stock sucks, and when they do that, you know, this is what happens from the moment when they say it to afterwards, okay? And so we're talking about it's adjusting in minutes based on that information that's getting into the marketplace through this dissemination mechanism, okay? So we can see that it's pretty fast. It comes into the marketplace. So how do we test this thing? You do event studies. M&A is being announced all the time. Companies make an announcement about something significant. There's earnings calls where significant information can come out. And then you can look at the cumulative abnormal returns and look at the risk-adjusted performance. Are the alphas roughly equal to 0 after fees? Okay. How do we know if the alphas are approximately equal to 0? Persistent, consistent. P-value is less than 0.05, okay? So we're going to look at it, and if the p-value is greater than 0.05, we couldn't distinguish between that intercept being at 0 or not, okay? So the joint hypothesis problem, you're testing the EMH and expected return model. You're testing in both of them at the same time. So I'll come back to this. I'll come back to this point. Okay. Now this is where I get this is where I start to get interested again in this stuff. But here's an example where our good friends Fama and French, and you can go get the data at Ken French's library, data library, I gave you the link. He constructed an index, and he constructs it all the time. It's always being updated. And yeah, and so like when I was working for Fama and French at the B School, I was one of an army of people who did some of this stuff. So what they did was they were racking and stacking all the companies by size. So they looked at the size of the company, and so this is the first decile, this is the second decile. So these are all the small companies all the way up to the largest. And then they looked at it historically and going back and saying, okay, what's the return profile if I had invested here versus here? And they basically used the lower quartile, small of size, versus the upper quartile of size. Racked and stacked the returns, and they created an index. And so what do you find? Well, what's the mean return here? It's roughly, let's call it 17.5%, okay, for this quartile. And so you're long that, and you're short. And over here, it's about like what? Let's call it 12.5. So by being long, these guys, and being short these guys, I make 5 points, 5%. Remember SMB, small minus big, factor model? They were doing this not because they were hypothesizing. They basically, the inside knowledge was everybody was noticing that a lot of fund managers were, especially large fund managers, were skewing their portfolio towards small caps. Okay, so this basically pulls that information out and turns it in, and that's why they turned it into a factor. Okay, it's a factor, and it's independent of the. It's not independent, but it has a lower. Its correlation with the market is less than 1. So basically, you've got a positive return, and you got a correlation with the market that's less than 1. So basically, what happens when you do that? What's the measure we always like to see going up? Our Sharpe ratio went up because our variance went down because we added an uncorrelated asset with a positive return. So SMB, small minus big, is a very, very large, in terms of explicitly betting on it, it's very large in terms like it's in the billions, tens of billions in hedge fund land. But then when you get to the fund complexes doing it, they do it implicitly by tilting their portfolio, and I'll come back to that. But basically, this is a very, very large diversifying strategy for anybody managing large amounts of funds. Okay. Okay, well, we had SMB. Well, HML. Remember what HML was? HML was high book value to low book value. So they went in and book to market. So basically, you look at the book value of a firm, and you divide it by its market price. Okay, we would just stack them, and so these are companies with low book value, with low book to market values. Okay, these are companies with high book to market values. So again, this is information, you can go look it up. Book is stated. It's what they're doing every time they do their the quarterly earnings, and they're basically they'll come out and they'll say what the book value of the shares are based on their accounting numbers. And you can compare that with the market price. Okay, and so low book value, seems to underperform high book value, okay? So again, let's say that that's, I don't know, let's call it 16. So let's say this is about 13, maybe 12 and a half. So about a 3.5 point difference, okay? Again, a positive return, not correlated because when they created it, it's not completely independent, but it has a lower correlation than the market. So, so we can see that, there are market anomalies in terms of value size and momentum, which is why we move from just the single factor model to the multi-factor model, okay? So here's another example of information getting into the marketplace. So this is, but how does it affect it? And we see, there's been an announcement, and you basically, in your event study, you rack and stack. Like, there was news, and the news came out, how did the stock move, okay? So you can basically break them down into, again, deciles of how the stock moved in each one of these cases. And then you can study how they performed over time. So again, this isn't any one stock, though. This is an aggregate. This is a bunch of stocks. We've looked at them, and this is the mean performance over time. So we see that the abnormal returns have this cumulative negative draw, and then a cumulative positive and positive news. Okay, we'll get into that when we get into behavioral finance. But that becomes something you can trade. So these are things that say that maybe the market isn't efficient. The strong form basically says insiders cannot earn abnormal profits. There's plenty of evidence of insiders earning abnormal profits. Okay, so again, they use those studies when they're looking at the M&A. So in terms of like the joint hypothesis problem, and this is a little abstract, but this is part of the problem in terms of doing these studies is you're always testing your theory with a model, okay? And so we might reject that, we might see that the prices misbehave or the model is wrong. So we don't know which one it is. So if most anomalies blur this line, the value, size, momentum, we can't clearly separate inefficiency of the model specification. So if we have an incorrectly specified model and I'm using that as my measuring stick, then I'm, that inadequacy in that model. So, so every test of efficiency is a test of your yardstick. If it's bent, even a perfect market will look crooked. Okay, so. So if markets are efficient, what does a portfolio manager do? Go to cocktail parties? Fly around to conferences? They diversify. They can have a big factor in terms of cost control, rebalancing, harvest losses. So efficient markets doesn't look at the tax position of someone. Okay, so you may look at something and say it doesn't make any sense to sell that, but in fact it's like, okay, well, I'm harvesting a loss to offset a gain this year because it's going to offset some tax obligation. But most importantly, like choosing factor tilts between value, quality, momentum. Okay, so that the SMB and the HML factor, and it may. So how did they do that? Well, they go to Ken French's website and they get the factors, and then they regress all the securities that they're looking at in their current portfolio against those factors, and then they construct a portfolio which maximizes their expected return versus their standard deviation. So they're going to basically maximize the Sharpe ratio off of that, and they're going to do it off of those securities. And they're going to end up with some amount of each one of these HML, SMB, and market in it. So there is still a role for portfolio managers. Non-overlapping return correlation should be zero. If significant predictability remains, it's a weak form violation. So you would want to look at you'd want to check it out of sample. Basically look at it. What is it net of costs? Did the costs net that out? So this is a bit more event studies. So this is just basically a formula for how you do an event study. So you define the event window, earnings calls, M&A announcements. You estimate what the normal return should be under the original performance, and then you calculate the abnormal return by looking at like what was the change versus the abnormal return, and then this basically it brings out the portion of the return that's not explained by market moves. So basically you're pulling the market out. So if they make an announcement and everything moves, and it moves, but everything else is moving at the same time, it probably wasn't their announcement. It's the market. So you have to basically split those two out from it. So so we're looking for the cumulative abnormal returns. We can look at the sum of the cumulative abnormal return, and that is that's the way all these event studies work. Okay, whether it's M&A or earnings or whatever the information is hitting. Okay. Earnings reaction. We already covered that. We can rack and stack them, but we also see that there's this long tail coming through here, and this is again, we'll talk about this, why this is happening when we get into the next subject. So interpretation is a sharp jump in CAR at T equals is a fast market adjustment, supports a semi-strong EMH, but the post-gradual drift pre or post announcement could be information leakage. So like remember we saw that the takeovers that was drifting up before it, that's information leakage. Or if it moves slowly, it could be slow assimilation of the information. Okay. So the great firm versus the great stock. Public info is already in prices under semi-strong EMH. But outperformance requires risk or mispricing, not just quality. Expectations versus realizations drive returns. Okay, In other words, it's going to be something that's going to moves the expectation. Thought I dropped this one out. I don't know why it's still here. Small firm effect. We saw that with SMB factor, small minus big. Historically higher small cap returns. Risk, distressed liquidity. Implementation costs. It's largely captured by the SMB factor in the Fama French. Key takeaways: prices move on news. Predictable edges vanish fast. Weak and semi-strong forms broadly supported. Anomalies exist but face costs, risk, and decay. So that's the efficient market hypothesis. Again, it's kind of hard for me to assess you on any of this, but in terms of like I'll try to point out what the heavyweight stuff is. But let's go to a okay, and this is just the last slide. We test for, I mean, this is something I can ask in a question. You can test semi-strong from event studies. What undermines a strong form? Insider profits. And why does the joint hypothesis matter? Because you're not only testing the data, you're also testing your model at the same time. Okay.